Hi there, Eric Blake, host of the Simply Retirement podcast. Before we get to today's episode, I wanted to share a quick heads up about an important live webinar we're hosting on Tuesday, August 26th at 6:30 p.m. Central. It's all about the new tax law, officially called the One Big Beautiful Bill Act. And it's already changing how your retirement income, Social Security, Medicare premiums, and even estate plans could get taxed. We'll cover what's permanent, what's temporary, and what smart retirees, especially women over 55, should be doing this year to make the most of these new rules. It's completely free. I'd love for you to join us. Just go to blakewealthmanagement.com/OBBBA. That's OBBBA to learn more and save your spot. Now let's get into today's episode. On today's show, we're going to talk about something that impacts more women than you might realize, and often they're unaware and unprepared. It's what's known as the widow's penalty. Welcome to another episode of the Simply Retirement podcast, where we want to empower and educate women to live your retirement on your terms. I'm your host, Eric Blake, practicing retirement planner with over 25 years of experience, founder of Blake Wealth Management, and I would not be the man I am today without the women in my life. And this episode matters deeply because many women find themselves navigating complex financial waters at a time when they're most vulnerable. Whether you've already lost a spouse or you simply want to be prepared, this episode will hopefully give you some clarity and some confidence. Joining me once again is Wendy McConnell. Wendy, how are you?
I'm good. Thank you for having me.
Absolutely. Well, so question. So do you prefer the my amazing producer, Wendy McConnell, or are you okay with just going straight, hey, here's Wendy McConnell?
However you feel about me that day. How's that sound?
That may
That's
not
a
be
setup. That's a setup.
I think you're setting me up. I think that's the
Yes.
problem.
Yes. No, it's just my name is fine.
Okay, excellent.
Okay.
Excellent. Well, so I know we've talked about this. This topic has come up kind of drips and drabs here and there on different episodes, whether we're talking about Social Security or some different topics that we've covered in the past. But we haven't really gone into the depths of what the widow's penalty is. So a question for you. Before we started doing a few of these episodes, before we started working together, had you heard about the widow's penalty, or what pops into your mind when you hear that term?
No, I had no clue. I'd never heard of it, so I had no clue what it meant.
Perfect. Yeah, perfect lead in. Then well, here we go.
Right. Inform me, please.
Absolutely. So here, basically what we want to do is we're going to walk through what the widow's penalty is, why it matters, of course. We're going to talk about why women are especially impacted, primarily we're talking about life expectancy and those types of issues as well. We're also going to talk about what it means for your taxes and Social Security. And then, of course, we want to make sure we talk about how to take control of your financial future. What can you do today or in the near future to hopefully minimize the impact? Or if you're in the middle of it already, what are some of the things you can be aware of as you go forward? For all the links and resources shared in the episode, please visit the simplyretirementpodcast.com. And if you have a question, topic idea, or a specific retirement challenge you'd like to hear covered on an upcoming episode, you can visit the simplyretirementpodcast.com/ask Eric. All right, so let's talk about what the widow's penalty is first. We'll start there, then see what your thoughts and questions are. But basically, the widow's penalty refers to the financial challenges that often follow the loss of a spouse.
Mm-hmm.
And it's not just being one thing, it's a combination of a few different things, really. The first is loss of income. Now, at a minimum, you're typically going to lose at least one Social Security benefit, right? So you get to keep the surviving spouse gets to keep the larger of the two, but one of them goes away. And again, that's going to be more impactful for certain situations than others. But then you have a possible reduction in income up from other sources. It could be pension if the spouse has a pension, or maybe it's business income, or whatever the other source of income might be. If that doesn't continue to the surviving spouse, obviously this loss of income could be even more significant.
Okay.
And then even more importantly, we think about you might actually might have a jump in your tax rate as a result of now having to file single versus filing married, filing jointly. Social Security alone can drop anywhere between 25 to 50%, depending on where both spouses are receiving benefits and how much they're receiving, whether they're both receiving their own benefit or one is receiving a spousal benefit. And we also know that if Social Security is your only or maybe your main source of retirement income, that drop can be devastating, especially when you're talking about fixed household expenses where they may not change a whole lot. Even though one spouse might pass away, your expenses may not change a whole lot. If you've got utilities, property taxes, all these different things. Now, on the tax side, the widow's penalty really shows up more when there's other income sources beyond Social Security. So thinking about things like IRAs and 401ks and pensions and rental properties, things that actually could continue on with the surviving spouse. Does that make sense?
No. So you're saying that she can still draw from his 401k, or
Yeah, so
does
let's talk. I've got an example. It might be may
okay.
help all this sink in a little bit. So I always call we call it Bob and Sue. So Bob and Sue for their clients have been they actually worked with us for a while. Unfortunately, Bob passed away just a few months ago. So you think about their situation again. So he had the higher Social Security benefit, so she'll get to continue that, but hers is going away. So that's already the loss of income from that standpoint.
Right.
But together, combined, they had about $1 million in IRA accounts. Now, part of it was his, part of it was hers. But when he passes, or when he passed, she now rolls that money into her own IRA. So it's a single person now. Unfortunately, she's a widow, but now the whole $1 million is under her name
Oh, and you get more leeway for a two-person family rather than a single person.
because the tax brackets are different. So what basically happened is now her income, and I'll explain why in particular her income won't change in just a little bit, but if her expenses or household expenses don't change a whole lot, she's really not in a position where she's going to take less out of the IRA.
Mhm.
And so because her tax bracket now could potentially be single versus married filing jointly, you could see how if her income doesn't change a whole lot, she might actually be pushed into a higher tax bracket.
Okay, so let me ask a quick question.
Mhm.
Is this a Does this pertain to the amount of money that they're counting as income, or the amount of money that you have to pay in taxes to retrieve the money? Like, I'm thinking Roth IRA. Would that eliminate any of these issues?
So you're jumping way ahead. You're
Oh,
getting into strategies now.
sorry. I'm
No,
sorry. Please.
it's a great point. I'm glad you asked it because again, we've talked about Roths and different things like that that can be a very valuable strategy. But unfortunately, when you think about most people's retirement scenario, where is most of their money?
Still in the
Most of their
four.
money is in the 401k, the pre-tax bucket, the IRA, traditional IRAs, the rollover IRAs, the 401ks. You hope that again, if there's some advanced planning that was done, there are some Roth accounts and some Roth assets that might be tax free. But in this particular circumstance, they're like many, many Americans in that most of their money is in pre-tax buckets. So if her income doesn't change, and in particular here, and I got the okay. I told her I wouldn't share her name, but I kind of walked through her scenario. So I did get her okay to share some of this. So she has two special needs adult sons that live with them. So how much can her expenses really go down if she's taking care of herself and taking care of them?
Hmm.
So her income scenario again really doesn't change. So she's going to have very similar tax of gross income, therefore taxable income, because she's going to have to still continue to take out the same amount and maybe even more ultimately from those retirement accounts. So
Right.
you've got a single filer now instead of married taking the same amount of income. Very likely that that's going to push her into a higher tax bracket.
Okay.
So now one thing I do want to touch on, this is an interesting situation and it's going to apply to some people, but not everybody, but I think it's worth bringing up because it's really something that impacts more likely younger couples than retired couples. But you'd actually be surprised how we've actually dealt with it ourselves a couple of times, unfortunately, the last couple of years, where if you and you want to talk to your tax advisor on this, make sure that it fits. But if you have a child, adult, minor, whatever the case might be, if you have a child that is a dependent, you actually could potentially qualify for what's called qualifying widow status. That's a filing status, just like single, just like married, filing jointly, but it specifically applies to a widow. And this is man or woman, doesn't matter, depending on who we're talking about. But the 2 years following the year of death, she'll be able to qualify under what's called qualifying widow status, which means that tax brackets are actually the same as married, filing jointly.
So this would pertain to Sue's situation.
It would pertain to Sue's situation because both of her children, both of her adult sons, are considered dependents. So she'll be able to use this, and it presents some really strong tax planning opportunities if you're even aware of it. Now, again, a lot of people would think, well, they're adults, whether they're special needs or not. I don't get to claim them as dependents, which is again not true in this case. So it presents some great opportunities. So you think about how it typically applies. Maybe somebody's farther away from retirement or younger couples, where the likelihood is they've got younger kids. That's really where this typically applies, but again, it does apply to our audience quite a bit, and in more than what most people might think about with that type of scenario. So you want to at least know that it's out there, know that is a potential opportunity. Again, present some tax planning strategies.
It's just for 2 years, though. That's it. That's all you get.
2 years following the year of death,
Okay.
exactly.
Gotcha.
So again, what it means is I just knowing and understanding how to utilize these strategies is critical, and we're going to talk more about tax planning opportunities later. But just keep in mind, if you or someone you know has a dependent child and they've lost a spouse recently, this might be something they can utilize from the tax planning perspective.
Always good to know, right?
Absolutely. That's all about knowledge, right? You got to be
Mm,
aware. You can't do it unless you know about it, right?
right. Exactly.
So let's talk about why it hits women harder than men. And this is nothing that's going to be surprising, but really, number one, it comes down to women live longer. So if you look, according to the CDC, women outlive men by about 6 years on average. And just using my grandmother's case as example, it's now 28 years since she became widowed. So you never know.
Mhm.
The average age of widowhood is 59 and a half.
Oh, that's so young.
It is. And again, that's significant. It's not just emotionally, but actually financially. And because you think about that age might ring a bell for many people. 59 and a half is also we talked about IRA distributions in a few episodes ago where, hey, we're talking about the tax implications of taking money out of retirement accounts. 59 and a half is an important year because that's the year you can start taking money out without penalty. After you actually have to hit 59 and a half, by the way, just so we're not throwing
Right.
anybody off of that. But just as another example, just another client scenario that we had a couple of years ago where he was 62, she was 58. He decided to retire, started Social Security. Unfortunately, within just a couple of months, passed away. And her situation was very similar in that she had been out of the workforce for about 20 years taking care of a special needs child. So she's 58, not yet 59 and a half, and everything they had as far as investment and retirement assets was in his 401k. So we had to utilize the planning strategies available to us in order to get her through that. And it was challenging for sure.
Because even if you switched them over to her, if they rolled over into her, she still wouldn't be able to access them.
If you do a direct rollout, exactly, and that's where I hate to tell horror stories about financial advisors not understanding the rules themselves, but so many times you say, "Well, I just roll that money from the 401k to an IRA and you're good to go." Well, that was her only source of income at the time. You roll that to just a traditional IRA in her name, she's under 59 and a half. She's not only going to pay taxes on it, she's going to pay a 10% penalty.
Yeah.
So from a planning perspective, and I've touched on this on other episodes, but from a planning perspective, basically all we were able to do is just roll it to what's called an inherited IRA, which again we've touched on at a past episode.
Okay.
But in an inherited IRA, she has no 10% penalty, still taxable, but she could at least access those dollars to live, to pay her bills, to help her get health insurance, all those types of things that we need to get done. So we had, again, understanding how the rules work, that became really critical in a situation like that. But again, if the average age is 59 and a half, that means there's a lot of women who find themselves on their own under that age. So what do you do?
Is that correlated, by the way? I mean,
I don't know.
seems very suspicious, but anyway, please proceed.
I don't know if somebody was that creative to try to connect those ages together, and then they're way smarter than I am. That's all I can
Yes,
say.
yes.
So that's number two. The average age again being 59 and a half. The average widows 59 and a half. Then we get to, of course, the women tend to have smaller Social Security and pension benefits, whether that's because they've historically had lower career earnings, or more likely than not, they've had time out of the workforce to provide care for, it might be children, it might be adult parents. But that again ultimately results in smaller Social Security benefits, smaller pensions, less retirement savings, and that all plays into these equations that we're talking about here.
Mhm.
And of course, number four, then we're talking about why this hits women harder. And this is more from a communication standpoint or a planning gap, just not being aware of this potential issue.
Mhm.
Right. So you think about in many households, they just you don't talk about these things. Nobody wants to talk about somebody dying. But realistically, at some point, it's going to happen. And as we see, sometimes it's sooner rather than later, but with that 59 and a half age. But sometimes, there's that sometimes a separation of duties where the woman handles the family and the household needs, and the man handles the finances, the retirement planning. And it's just, again, the communication aspect is not there, or there's not a comfort with talking about these types of things. But unfortunately, it's usually the woman that ends up on the other side of this being, okay, what do I do now? I lost my husband. He handled a lot of these things. What do I do? So that's a big part of this conversation is you got to have you got to have the conversations. You got to start bringing this up and say, okay, what would happen if something happens to you? Where does that leave me?
Right.
Where would my income come from? And this is really where, because the unawareness, we'll call it, of the widow's penalty, you got to know that it could happen to you.
Yeah, I mean, women should really just bring it up as a protective mechanism for themselves. And, I know it can be uncomfortable, but at the same time, it's going to be really uncomfortable if something happens and you're stuck.
My guess would be even almost even more comfortable, right? In many cases, if you weren't making the decisions and now it's all on your shoulders,
Yeah.
it's going to be a much more uncomfortable bringing up the conversation. And I think
R-
that's one of the things we always talk about some of these past episodes. I've referenced a few already, but please think about, if you're having trouble with those conversations, and it might be, you might want to have them, both spouses might want to have them, but you just don't know where to start. That's
hmm
also an issue.
hmm
So you don't know where to start, so you just don't start.
Right.
So going back to episode 59 with Kathleen Kingsbury, Breaking Money Silence gives you read her book, listen to that episode, gives you some prompts, some things to start those conversations, some ideas to start those conversations. Because again, at some point it's going to happen. We know both spouses aren't going to pass away at the same time. One or the other is going to pass away first. Most likely it's going to be the husband that passes first, leaving the wife with, what do I do? Where do I go from here?
Right. Well, and then even thinking that if it is the reverse, the penalties aren't as extreme because the male typically has the higher Social Security benefit.
That's true, but you do lose one. So again, a lot of that then comes down to what's my expense situation look like?
Okay,
Can I
gotcha.
reduce my expenses enough for it to be less impactful?
Mhm.
And even again, this applies to men and women equally in terms of the end result. It's just that actually more women get impacted because of the life expectancy, all those types of issues that we touched on already.
Gotcha.
So let's think about just kind of talking back to, so that we've gone through why it impacts women more than men for the most part. In terms of just the tax part. So again, we broke it down. There's really two pieces of this. There's a loss of income with the potential of being in a higher tax bracket potentially.
Mhm.
Let's touch on the tax situation again, just to make sure everybody understands how this works. So again, actually, when you're married, you file married filing jointly.
Mhm.
Well, when one spouse passes, now I'm filing single. So that's the biggest part of it. Now, I will say this is a really big key thing to be aware of. In the year that you lose a spouse, you get to still file married filing jointly, right?
For that
So you need to
year.
be aware of that. Exactly. So that's when we always talk about, and it was kind of funny in Bob and Sue's situation that I brought up earlier. The first meeting we had, she actually brought that up. She said, "Didn't you talk about this at one point, that if one of the spouse passes away, there's something called that I might have to pay more in taxes." She didn't remember the widow's penalty, but she remembered us having that conversation.
Okay.
So from that standpoint, again, it's just being aware. You may not necessarily know what to do, but if you at least understand that it's out there and that you've heard it, and you can ask somebody, you can ask your financial advisor, you can ask your tax advisor, what do I do? How do we handle this? But that does present some planning opportunities. You hate to think about it as an opportunity, but in the year of death, if you've got this year where you get to file married filing jointly, what are things I could do? What are the things that could impact my tax liability in the future that I can do this year? And we're going to talk a little bit more about that in just a bit.
Okay.
But let's talk about some of the other factors that could play in this as well. So it's not just the tax rate that could change. Depending on your income, you actually could hit what are called IRMA surcharges. Basically, higher Medicare premiums for Part B and Part D. If your income is high enough, and you're a single filer now, you might end up paying for more for Medicare. We also know the new tax bill. We talked about this on the last episode 65. We got this one big, beautiful bill act now, which presents again, some planning opportunities with this new age 65 deduction. That is a great thing, or can be a great thing from a planning perspective. But if your income is too high, you might lose it, or it might get reduced. So again, be aware of these things. And then we got RMDs, we got required distributions. We had touched on this a little bit earlier, but if you've got, between two spouses, you got $1.5 million, whatever that number is in IRA dollars that eventually have required distributions. Well, again, if both of you are still living, you've got required distributions for both. It's this basically could be the same amount, but at a married filing jointly rate versus her. And going back to Sue, now she's got $1 million in IRA assets. She's going to have a required distribution, but she's going to be filing a single instead of joint.
Right.
Right. So that's where the tax, and we're talking about the tax aspects of the widow's penalty. Those are the types of things that we're talking about. And that's why planning ahead in those years prior to death, because we don't know when that's going to be, that's why it's so important.
Yeah, for sure.
And then we start thinking about, that's where, again, we rarely know when that year of death's going to be. Sometimes there's other issues that are known to us. But that's where these years, say potentially between, say, 62 and 72, before Social Security starts, before required distributions begin, before enrolling in Medicare. These are really critical planning windows. And of course, every situation is individualized, but based on your situation, where are those tax planning windows of time for you? So if you plan to retire at 65, but you're not going to start Social Security until 65, or maybe you retire at 62, but you don't want to start Social Security until 65. Does that give you 3 years where you might consider some Roth conversions or some additional IRA distribution, those types of things? You got to be aware of those.
Okay.
And I would definitely want to an episode very soon on going deeper into RMDs. But just so we touch on that as part of this piece of the conversation, if you're born before 1960, your RMD age is now 73. If you're born in 1960 or later, your required distribution age is now 75. So again, I just point that out to be aware of where your windows of opportunity, your planning opportunity may be from a tax standpoint.
So you can put them off until age 73 or 75.
Yeah, so there's a lot of situations where I've got other income. Maybe I might just because want to continue to work until 70. Maybe I continue to work until 70. Maybe I start my Social Security at full retirement age, so I'm not losing benefits because of that. But if I don't need the income, I might continue to delay any type of IRA distributions.
Okay.
Well, the negative part of it, again, it's a good problem to have, but the negative part of that is okay. Well, if I never take any out and I've got sizable IRA dollars, every year I'm delaying taking anything out is growing my required distribution amount.
Okay.
So from a tax planning perspective, you might be creating this big tax time bomb that's just sitting waiting there that you don't know about until it's too late to do anything about it.
That sounds like a good time for a Roth.
It sounds like a great time for a Roth. Exactly. So, but you got to know when your windows of time are based on your goals, when I plan to retire, what my income sources are, where are those windows of time that I can do Roth conversions? Or if I am working, again, there's so many people, the definition of retirement has changed so much over just the last few years where there are more people working,
Mhm.
even if it's just 10 hours a week, 15 hours a week. We talked about the episode of, what are you going to do with your 1,000 hours? A lot of people are going to work. If you're working and you've got earned income, Roth contributions are still an option. Even if you're 75, you're 80, it doesn't matter how old you are. If you've got earned income, you can still contribute to a Roth. So keep that in mind. Again, we'll kind of touch on that again once we get to the strategies here in just a bit.
Okay.
So we talked about the tax component of the widow's penalty. Now we got the Social Security considerations. And the biggest thing is have a filing strategy and communicate that. You got to talk about that. When am we going to file for Social Security? If there is a higher earner, as best you can we delay that benefit to age 70 to maximize the benefit itself, but to also maximize the survivor benefit? Right. So if there is an income disparity there, think about what that would look like. When should the higher earners file? When should the lower earner file? And have a plan. Understand what the implications are. And again, that's one of the things that you got to communicate about. And I think I always say Social Security is such an underrated aspect of retirement planning. But just like the example I gave of we'll call it again the other Bob and Sue, one that Bob passed away at 62 and Sue's 58. He started Social Security at 62. She has not reached 62 yet. She's actually was eligible for survivor benefits as early as 60, but under the circumstances, it wasn't the right timing for her. But you see the impact of that her survivor benefit is significantly less than what it could have been.
Right.
Right.
Yeah.
So you got to have these things, you got to have these conversations and just talk about what the eligibility rules are, just to touch on a few of them. And then we've hit on these in other episodes. But for survivor benefits, you got to be at least 60 in order to claim survivor benefits off of a spouse. You have the opportunity to switch. So from a planning perspective, you can switch from your own benefit to survivor or vice versa, depending on which benefit happens to be higher. You almost always want to try to delay the larger the benefits. And then get just timing and coordination with your other income sources. That becomes really critical. Again, looking at those windows of time. When did I start Social Security? When do I start IRA distributions? When do I start pension income? All those different types of things. You got to fit all those pieces of the puzzle together.
When is the best time for couples to talk about these issues? 55, 58, 59, 60. Like, give you some parameters here.
I mean, you could start talking. You ought to at least know the rule, the basics of the rules, and at least as early as 50, maybe even sooner than that.
Okay.
Now, from a planning perspective, what I was talking about is say, okay, if you're in your early 50s, late 40s, early 50s, and we're building a retirement plan, just kind of go with the assumption that you're going to start at full retirement age.
Okay.
Because what you can do is you say, okay, well, let's plan on full retirement age, and as life happens, whatever that looks like, we can always adjust that.
Right. Okay.
Right. So you can say, well, as we get, if you have if our income situation changes, maybe one spouse was the higher earner, but now the other spouse has become the higher earner for whatever that might look like. So you can always change your plan. So we say, okay, let's kind of have our baseline goal of starting in our 50s. What is our retirement situation going to look like? And then say, okay, as we get closer, we can always adjust our plan based on that.
Okay, so as a 55-year-old woman with a 55-year-old husband, I should already know when we're going to be what age we're gonna be using
You should have some idea.
Social Security for myself and for him and all of that. Okay, I'm behind.
So, so you think about, so for right now, you're still at the point where we say, hey, we plan on 67. Let's say our full retirement age, we plan that's when we would take it. Now, what you want to know is, okay, what's his benefit? What's my benefit? What is that going to look like? Depending on the ages, is one spouse significantly older or younger than the other spouse? And how does that change things? So you want to have and what we kind of do is put together an income timeline. You say, okay, let's at least have a ballpark of what this is going to look like. So if I wanted to retire, say you say, okay, we plan on 67 for Social Security, but maybe you want to retire at 65. So what are those income sources going to look like? When would you see Social Security kick in?
Okay.
And make those decisions based on that. And again, as you get closer, we can always tweak the plan a little bit to make sure it's more appropriate. And again, unfortunately, as we have already seen, if 59 and a half is the average age of a widow, plans can change drastically without much notice.
Yeah, I don't like that one.
Nobody does. But you don't want to get caught off guard. And that's ultimately the bottom line is
Exactly.
you got to be aware of it. Doesn't mean it's going to happen tomorrow. There's always people talk about, well, if I get my estate, I'm not going to get a will done because if I get a will done, I'm going to die. That's not the way it really works, right? You would absolutely be amazed at how many times that people that's in their mind of, well, if I do this, then it's a bad thing. I'm like,
Yeah, I guess,
yeah,
I guess.
it's much more worse on the people that care about you than it is for you if that actually happens. If they have to figure it out on their own. Okay, so let's talk about strategies. So we've touched on these as we kind of dabbled on this a little bit already, but as you start walking through some of the key strategies to help reduce the long-term impact of the widow's penalty, think about these as being proactive steps, ideally to consider before the loss of a spouse, because actually once they're gone, some of those opportunities are also gone. So we've talked about, take advantage of the joint tax bracket. So if your income is going to be about the same, whether it's one spouse or two, should you be thinking about Roth conversions or IRA distributions in those lower tax bracket years while you are filing jointly, right? So you got to be aware of those capital gains harvesting. So if you're in a lower tax bracket and you're at the 0% long-term capital gains, so you've got some mutual funds or some stocks or whatever it might be, where you could say, hey, if I needed income, I could sell those at a 0% capital gain versus if my spouse alone is filing single and now they're selling those and now they're paying 15% capital gains. So just some of the different things you want to be aware of as far as the tax rates go. We've already touched on this a little bit, but Roth conversions to minimize future tax exposure. So saying, okay, we talked about required distributions, that's only from pre-tax buckets. You only have required distributions for pre-tax accounts. So if we can do some Roth conversions and create that tax-free bucket, that's going to reduce future requirements, but it's also going to give us another source of income that if my income needs don't change a whole lot, now I have a tax-free bucket to pull from versus just a taxable bucket.
So you can do a required minimum distribution into a Roth account, and then you'll just have to pay the taxes that are owed on that?
So it depends on your age. So let's talk about age. So once you've hit required distribution age, you always have to take your requirement no matter what.
Right.
You can't convert your required distribution amount. You can convert above that. So let's say you have a $10,000 required distribution. You're 73 years old. You got a $10,000 required distribution, but you're in a low tax bracket. Maybe you're in the 12% tax bracket.
Okay.
So I could say, well, I've got to take my 10,000. I get Uncle Sam says, yes, you still got to take that. But maybe I've got room in that 12% tax bracket. Maybe I could convert an additional 10 on top of that.
Okay.
So you might have $20,000 in taxable distributions, 10,000 that Uncle Sam says you have to take, which you can do whatever you want to. You can spend it, you can put it in a bank account, you can do whatever you want. You just got to get it out of the IRA account. But then I could convert an extra 10 that goes just like I think what you're describing, going from the IRA into your Roth. That's a conversion, not a contribution or a distribution.
Well, what are the rules that are stopping me from doing that? If it's a required distribution and I'm paying the taxes on it, why can't I put it in the Roth?
Because it's so once you've taken it out, you can only that would then be considered you'd have to contribute versus convert. So we're getting two different concepts confused a little bit. So you've got contributions, which you can make to a Roth IRA if you have earned income.
Right.
You've got conversions, which is basically saying I'm going to grab part of my pre-tax IRA and drop it into my Roth IRA. The requirements around those two different things, those two concepts are different. So what you're describing, the only way you could do that is saying, okay, I would take a distribution from my IRA account and then put it in my Roth. The only way you could do that is if you had earned income because you're actually talking about a contribution versus a conversion.
And there's limits on contributions, correct?
Basically, that you have to have earned income. That's the primary limitation is that you have to have earned income to make a contribution.
We need to do a whole episode on this because my head is rattling.
That makes sense. Yeah. So you got conversions, you got contributions. Depending on your situation, you want to know which of those options is best for you and whether it even fits. Again, understanding what your tax situation.
Okay.
So we've touched on this one as well, making Roth contributions if you're eligible. So if either spouse is working, even if it's just part-time, you might be able to contribute to a Roth IRA account or even make spousal IRA contributions, spousal Roth contributions. That could help you build that tax-free bucket to give you some tax flexibility in the future as well. So if only one spouse is working and they're making, this year, the Roth contribution limit is $8,000 per person. If you got one spouse that's making $16,000, that's $8,000 to the working spouse Roth account. That's $8,000 to the spouse, to their Roth account as well as a spousal contribution.
Okay. Okay. That makes sense. I like that.
So what you said is doable if you're eligible to do it because you have earned income.
Okay.
So you might have a required distribution still, but you can't take a required distribution and convert it. You've got to take it out and then contribute it if you're eligible to do so.
I still don't understand if we're paying the taxes on it, why it matters. But again, we're going to get into that at another time.
Uncle Sam cares. That's all I'm going to say.
Okay.
Uncle Sam says what we got to do, so we just follow the rules. That's all right.
Sometimes I ask too many questions, Eric.
Hey, like I said, if you have that question, somebody else out there does as well. But I completely agree, though. We do definitely need to do an episode on Roth conversions, Roth contributions, on Roth IRAs, period. What is a Roth? How do you get money in there? All that good stuff. I think that's definitely an episode that needs to be on
Okay.
the radar. Number 4 is reevaluating your withdrawal strategy while both spouses are alive. We're talking about required distributions, but should you be taking more out in those early years versus waiting to take it out in the later years? So those types of things. So prioritizing which accounts to draw from first in retirement. That's a big aspect of this as well. Then, of course, we've already touched on this, coordinating your Social Security strategy thoughtfully.
Mm-hmm.
If at all possible, delaying the higher benefit of the two spouses to 70. That'll always maximize the benefit while you're alive, but also maximizes the survivor benefit. If you can't delay till 70, delay it as long as reasonably possible. Actually, life happens. You just don't know what the circumstances are, but that is going to maximize the income while you're alive and maximize the benefit to your survivor. Life insurance. Again, we don't always think about life insurance in retirement. You say, hey, well, I'm retired. I've reached financial independence. Don't need life insurance. Not always the case. If there's going to be a significant change in income, if one spouse passes away, you really might think about having life insurance even on into retirement. So that's definitely something that needs to be on your radar if you're aware that there's going to be a big change in income when one spouse passes away.
Okay.
Last thing we'll talk about is if you've already lost your spouse, obviously it's a time you still need to reevaluate your income, look at your tax situation, look at your withdrawal plan. Obviously, some of the rules are going to change, but you need to be aware of some of these other pieces of this puzzle, like qualifying widow status. Some of those things that could apply to you, that even just as simple as the married filing jointly in the year of death, that you can still file jointly, even though your husband may have passed away, you still have that year. It doesn't always work out. We unfortunately had a client that, he passed away very mid-December and there just wasn't, it's not like I can pick up the phone and say, hey, we need to do some tax planning here in the last 2 weeks before Christmas. So it doesn't always work out in your favor, but again, you just need to know that some of these things are out there so that if it is an opportunity to do something, then we don't lose it.
Okay.
Again, make sure you work with a financial professional who understands the widow's penalty and can help you plan build a plan that supports what your next chapter is going to look like.
Mm-hmm. For sure.
Real quickly before we wrap up, thinking about also actually, we didn't really touched on divorce, but there are a lot of the aspects of this that would impact somebody who's getting divorced as well. So you think obviously you got a loss of income. If you're of Social Security age and you're both receiving Social Security, you need to know what's going to happen there, because actually now it's still going to be you filing single on one Social Security benefit, depending on what the split of assets looks like. Again, if you've got sizable IRA accounts, again, your income may not change, but you might be in a higher tax bracket as a result of going through a divorce. So a lot of these things are going to apply there as well. And I think that maybe even that's worth an episode down the road. But just understand a lot of these things we've talked about could actually apply in a divorce situation, just like it does the loss of a spouse.
Okay. But not all of them.
Not all of them. Uh, Anything else? Any other things you felt like we need to recap, or any other thoughts or questions you have?
Yeah, Roth IRAs.
Get that on the radar. Okay, we're going to get that done. We're going to get that done.
All right. I'm good.
Excellent. Well, if you're on the other side of losing a spouse, or if you simply want to take control of your financial future sooner rather than later, we would love the opportunity to help. At Blake Wealth Management, we specialize in helping women make smart decisions around income, investments, taxes, especially when life takes an unexpected turn. Feel free to visit getmysimplyretirementroadmap.com to get your Simply Retirement Roadmap. That is our 3-step process designed to help you answer your biggest retirement questions with clarity and confidence, because you do not have to do this alone. As just a heads up, over the next few episodes, what I want to do is continue on with this theme of helping you make these decisions after becoming a widow. We want to help you make them as reasonably effective as possible. What we're going to do is a few episodes on what to do in the first week, the first month, and the first year following the loss of a spouse. And I've actually got a document that we've built and we put together that outlines all these steps, and we're going to be sharing that as part of those episodes. So definitely want to make sure you tune in for that. That is it for today's episode, though. For all the links and resources, again, please visit the simplyretirementpodcast.com. Please don't forget to like, follow, and share the show. And until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
That's it for today's episode of the Simply Retirement Podcast. We hope you found our insights and advice helpful in planning for a fulfilling retirement. Don't forget to take action on what you've learned today. Visit our website at blakewealthmanagement.com to learn more about our firm and review our Simply Retirement Roadmap process to get you on the right path to the retirement you deserve. And don't forget to click the follow button to be notified when new episodes become available. Thank you for joining us on this journey, and we look forward to helping you achieve your retirement goals. Remember, retirement is not the end of the road. It is the start of a new journey. So embrace it and make the most of it. Until next time, take care. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor, Blake Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.